The Oracle of Omaha himself, Warren Buffett, is known for his aversion to idle cash. But where does he look for that sweet investment growth? Stocks are great, but what if there are even better and possibly cheaper options hiding in plain sight? Let's look at some Buffett-approved ways to make your cash work harder for you. Stocks.
On this March 11th, in a couple of weeks, it'll be 77 years since I bought my first stock. And I paid $114.75 for 3 shares of City Service Preferred.
Investing is a powerful tool, and 2 popular options are stocks and mutual funds. But what's the difference, and which is right for you? Think of stocks as owning a piece of a company. When the company does well, its stock price goes up, and you potentially profit. But if the company struggles, the stock price falls, and you could possibly lose money. This can be exciting, but also risky. Mutual funds offer a way to spread your risk.
Yeah, I would say that in terms of the index fund, I would just take a very broad index. I would take the S&P 500 as long as I wasn't putting all my money in at one time. If I were going to put money into a index fund in relatively equal amounts over a...
For this, think of a basket filled with colorful eggs. Some blue, some green, some yellow. Each color represents a different company's stock. A mutual fund lets you buy a few eggs from this basket, giving you a piece of many companies at once. Even if a few companies have a bad day, the others might balance things out. Now, here's the best part. Professional managers pick the stocks for you in a mutual fund. They research different companies and try to choose ones with the potential to grow. This saves you time and effort compared to picking individual stocks yourselves. Another perk? Mutual funds can be surprisingly affordable.
Index fund in relatively equal amounts over a 20 or 30 year period, I would pick a fund, and I know Vanguard has very low costs. I'm sure there are a whole bunch of others that do. I just haven't looked at the field, but I would be very careful about the costs involved.
There are types called index funds that simply track a market index, like the S&P 500, which represents 500 of the largest U.S. companies. Think of it like buying a miniature version of the entire basket, instant diversification without the hassle. So, which is better, stocks or mutual funds? Well, it depends. If you're new to investing or prefer a less risky approach, mutual funds, especially index funds, are a great place to start.
Well, I'll be very simple. Under the conditions you name, I'd probably have it all in a very low-cost index fund. And it'd probably be, might be Vanguard, somebody I knew was reliable, somebody where the cost was low.
They offer diversification and professional management. But if you're an experienced investor comfortable with higher risk, carefully chosen individual stocks might provide the potential for bigger gains. The key is to understand your options and choose what fits your comfort level and goals. Remember, investing is a marathon, not a sprint. With time and the right strategy, you can build wealth and secure your financial future. If stocks and mutual funds are not a choice, then you can try investing in raw materials. Raw materials. Imagine the building blocks of our world: metals for electronics, oil for energy, and agricultural products for food. These are all raw materials essential for countless industries. Investing in raw materials allows you to tap into this ever-present demand. Here's the beauty. Raw materials are often considered a low-risk option compared to individual stocks. Why? Because they're the foundation of so many essential products. As long as economies function, the need for raw materials remains strong, offering a sense of stability to your portfolio. Think of it this way. During economic booms, the demand for raw material rises as industries ramp up production. This can drive up their prices, potentially increasing your investment value. But even during downturns, raw materials often hold their ground. Companies still need them to operate, and some raw materials like precious metals can even become more attractive as safe haven investments during uncertain times. Another benefit is that raw materials can generate consistent cash flow through dividends.
Big opportunities in life have to be seized. We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it. And even to do it in a small scale is just as big a mistake almost as not doing it at all.
Many companies involved in extracting or processing raw materials share their profits with investors through regular payouts. This provides a steady stream of income alongside any potential price appreciation. Of course, no investment is risk-free. Supply and demand fluctuations can impact raw material prices. Geopolitical issues or natural disasters can also disrupt supply chains. However, by strategically diversifying your portfolio with a mix of raw materials, you can potentially mitigate some of these risks. So, how do you get started investing in raw materials? There are several ways. You can invest in companies directly involved in mining, processing, or trading raw materials. Examples including Nucor, a leading steel producer, and Rio Tinto, a global mining giant. Also, you can invest in ETFs or exchange-traded funds that track specific raw material indices. This allows you to gain exposure to a basket of raw materials, further spreading your risk. Still haven't gotten your interest yet? How about trying the popular real estate? Real estate.
$1,000 to $11 million. That is a phenomenal growth.
And when I bought it for $150, I borrowed some money from Great Western Savings and Loan, so I probably only had $30,000 of equity in it or something like that.
Why did you have a mortgage on it? You didn't need one, even in 1971, did you?
I still thought I could probably do better with the money than have it be an all-equity purchase of the house. You know, that $110,000 or $20,000 I borrowed, I was buying Berkshire then.
Real estate has long been a coveted asset class, and for good reason. Compared to stocks that can experience wild price swings, real estate tends to be less volatile. Plus, there's the historical trend of property values generally rising over time. Of course, everyone knows the struggle with skyrocketing house prices. Buying a home can feel like a major hurdle, but here's the thing. While the initial investment might be high, the potential for consistent returns is undeniable. Imagine this. A recent Zillow statistic showed that in just 5 years, home prices in America's largest real estate market doubled. That's a significant return on investment. So while the upfront cost might seem daunting, considering real estate as a long-term investment strategy can be very rewarding. There are some ways you could get involved in real estate investing. First is direct ownership. Purchasing a rental property allows you to collect rent and benefit from potential value appreciation. Then there are REITs, or real estate investment trusts.
REIT investing is a type of investment that allows individuals to invest in large-scale, income-producing real estate assets.
These are companies that own and operate income-producing real estate. You can invest in REITs through the stock market, gaining exposure to the real estate market without directly managing a property. There are pros and cons to consider, of course. Real estate requires ongoing maintenance and management, which can be time-consuming or require hiring help. Additionally, the market isn't immune to fluctuations. However, for those seeking a potentially stable, long-term investment with the potential for consistent returns, real estate can be a powerful tool for building wealth. Luxury and commodities.
And to my knowledge, Charlie will hear from him, but we have no opinion on commodities. But it does not mean that we think the price of oil is going up. If we thought oil was going up, we could buy oil futures, which we actually did once.
While stocks and mutual funds are popular investment choices, there's a whole world of alternative assets that can diversify your portfolio and potentially offer unique advantages. One of them is luxury handbags. Forget the fleeting trend. Your wife might have been right about that designer bag. High-end handbags, particularly those crafted from exotic skins like crocodile or ostrich, can be surprisingly valuable investments. Similar to vintage cars, their rarity and quality contribute to their appreciating value. For instance, iconic Birkin bags from Hermes have seen a staggering 14% annual increase over the past 35 years, outperforming the S&P 500. While entry points can be high, ranging from $10,000 to $30,000, some resale platforms like Poshmark offer opportunities to acquire them at a discount. However, remember, this market has its limitations. Authenticity is crucial, and proper storage and maintenance are essential to preserve value. And the vintage cars we mentioned earlier? An example of this would be Ferrari 250 GTO. Back in the early 1960s, you can get your hands on one for about $18,000, which would be roughly $183,000 in today's money. And until 2022, this legendary car held the record for the most expensive car ever sold at auction, fetching over $48 million in 2018. Which car broke this record? You guessed right, another vintage car, specifically the 1955 Mercedes-Benz 300 SLR, known as the Uhlenhaut Coupe. Sold for a massive $142 million. You now get the point. There are also commodities. Commodities like oil, cotton, and gold have been around for centuries, used for barter before the concept of currency even existed. Today, with the rise of online platforms, investing in commodities has become more accessible. You can trade futures, options, and contracts for various metals, energy sources, agricultural products, and more. The beauty? Commodities tend to be inflation-proof, as their prices generally rise alongside inflation. However, don't be swayed by short-term price spikes. While exciting, a long-term perspective focused on strong, productive businesses is often a wiser strategy. For beginners, consider investing in pre-made commodity indexes that offer greater stability. Let's go back to luxury. Ever wondered why successful people often sport flashy Rolexes? Turns out these luxury timepieces aren't just a status symbol, they're also potential investments. Like luxury handbags, a watch's value often depends on its rarity and production numbers. Limited edition or discontinued models tend to appreciate significantly over time. This appreciation is further fueled by inflation, as the value of the watch rises alongside the weakening currency. For example, a Rolex purchased in 1957 for a few $1,000s could be worth tens of thousands today. Popular choices for investment watches include the Rolex Submariner, Cartier Santos, and the Patek Philippe Nautilus. Take the Rolex Daytona, for instance. Similar to the Ferrari, the Rolex Daytona wasn't initially considered a top investment piece. Introduced in the late 1960s, its primary function was to be a tool for endurance racers. Early models could be purchased for around $200. And, as you expected, the prices for these coveted Daytonas shot up. In 2020, a Rolex Daytona once owned by actor Paul Newman sold for a massive $17.8 million at auction. But hey, just like any other investment, there are things to consider. These alternative investments offer exciting possibilities, but they also come with unique risks. Before investing, consider factors like market volatility, liquidity, or how easily you can sell your asset, as well as storage requirements. Additionally, some options like fine art, which can be a fantastic long-term investment, may require significant capital to get started. If you've not found your pick, how about considering precious metals? Precious metals. While gold often rules in conversations about precious metals, two other metals deserve attention: platinum and silver.
If you go back to the time of Christ and you look at how many hours of labor you had to give up in order to buy an ounce of gold, and you take it forward to now, you'll find the compound rate maybe a tenth or 0.2%, and then you have to insure it during that time and make sure somebody doesn't steal it from you and everything.
Platinum alongside gold and silver is considered a major precious metal. However, its appeal goes beyond simply being valuable. Unlike gold, which is primarily used in jewelry and electronics, platinum has an important role in industrial applications, particularly in catalytic converters for automobiles. This dual use as an investment and industrial metal contributes to its active trading. The key characteristic that sets platinum apart is its scarcity. It's more rare than both gold and silver. This limited supply can translate into long-term value appreciation, especially considering the ongoing demand from various industries. Additionally, platinum tends to exhibit price movements similar to gold and silver, offering a potential hedge against inflation that can erode the value of currencies. Silver's value extends far beyond its use in jewelry and decorative objects.
And there were huge quantities of silver that could possibly be removed from other uses, perhaps, in jewelry and all kinds of things that could conceivably add to supply, as they did in the early 1980s when the Hunt Brothers thing took place.
This versatile metal plays a crucial role in modern technology. If you condensed all the world's silver into a single cube, it would only measure about 67 feet on each side. This seemingly small amount is surprisingly critical for our everyday lives. Silver is a vital component in countless items, from solar panels and cameras to telephones and computers. This industrial significance aligns perfectly with the Warren Buffett rule of investing. The rule emphasizes choosing assets with a clear and inherent value. Silver's undeniable usefulness in technology makes it a strong candidate for this principle. Replacing silver in these applications would be incredibly challenging, solidifying its position as a potentially valuable long-term investment. Now, while some predict a potential 1,000% increase in gold prices by 2033, it's important to remember that such claims are speculative. Predicting the future of any market with absolute certainty is impossible. However, there can be opportune times to invest in gold, according to some analysts. These periods may include early January, March, April, June, and July. However, relying solely on this information wouldn't be a prudent strategy. Yourself.
By far the best investment you can make is in yourself. I mean, for example, communication skills. I tell the students that come that if you invest in yourself, nobody can take it away from you.
While all these we've looked at could be choices, don't forget to invest in the most important asset this world could have: you. This investment starts with fueling your mind. Learning is a lifelong journey, and there's no shortage of ways to keep yours sharp. Dive into online courses, devour captivating books, or listen to enlightening podcasts on topics that pique your interest or hold career-boosting potential. A well-trained mind is a magnet for new opportunities, allowing you to tackle challenges and excel in your endeavors. Next, focus on sharpening your skill set. Take stock of your strengths and weaknesses. Identify areas where you need to excel and invest in honing those capabilities. This could involve attending workshops, acquire certifications, or taking advantage of online learning platforms. Remember, a skilled professional is a valuable asset, both to yourself and to potential employers. And now that you have all the information, what are you going to do with it? Maybe subscribe to the channel as you're on about it. See you next time.